The J.I. Case Company of Racine, Wisconsin presents Profit Power. Are you operating your business on a collision course with a crisis, or do you have your sights set on a profit goal? More important, do you have the power to increase your profits? As a dealer, you're the ball carrier. You deal with the customer, and as we all know, the customer is the real boss in any business. But he stays your customer only if you treat him right. For example, your customers expect above-board deals, promises that are kept, prompt, reliable service, adequate parts and accessories, complete financing service, friendly employees, and year-round stability. As a customer, you'd expect the same. And the dealer who provides it is the dealer who gets your business. To increase your profit power, it takes everything we've mentioned, plus sound business management. You have the power to increase your profits. To do so, however, means facing up to a number of important questions. For example, am I making money on my case contract? What's my margin on new and used equipment sales? What's my parts and service department margin? Am I using credit selling to increase sales and profits? What are my expenses in relation to total sales? Are my customer open accounts too high? What is my used equipment turnover? What is my real profit? Profit is the main goal of every dealer and the acid test of every business. Every year, the increasing complexity and competition of business makes good business management more essential for business survival and future growth. This means you must keep complete, accurate financial records, use the records to determine corrective action, and take necessary action without delay. There are dealer associations that have cost studies and accounting systems tailored for your use, such as the National Farm and Power Equipment Dealers Association. Most state and regional associations will help you set up a bookkeeping system and give instructions to your bookkeeper or accountant. Associated equipment distributors do not have their own bookkeeping system, but they have mentioned Norwich as an acceptable system. And AED does publish an annual cost of doing business study. These systems center on the financial statement and the operating statement. These monthly statements are your tools for measuring your business success. They give you a quick look into every department of your business and tell you how you're doing. The financial statement tells you where you are as of a specific date, and the operating statement explains how you got there. Your assets are everything you own, from cash on hand to prepaid insurance, from your new and used inventories to the hoist and other equipment in your shop. Your liabilities are made up of your total indebtedness to your creditors. Net worth is the difference between the two. All you do is deduct your liabilities from your assets. Your operating statement helps you measure the ability of your business to generate profits. It also lays the groundwork for isolating your business's strengths and weaknesses. With the financial and operating statements, you have the power to increase your profits. Here is the monthly financial and operating statement of an actual case dealer. Let's examine it closely. This dealer's cash on hand or in the bank totals some $24,000. But the old theory, as long as there's money in the bank all is well, isn't always true. Someone can be waiting to take it away from you, and it's necessary to look much deeper into the financial statement for a true picture. His receivables, money due the dealership, add up to $29,000. His inventory of new equipment, used equipment, and parts totals almost $246,000. Fixed assets total over $28,000. Liabilities show that he owes almost $258,000. After this amount is deducted from his assets, his net worth is $70,000. This dealer has certainly kept accurate financial records of every transaction, the first step in increasing profit power. Now let's take a still closer look at the financial picture. His inventory of $246,000 includes $94,000 in used machinery. Now let's move on to his operating statement. If the operating statement is to give a true picture of the margin obtained in the sales of new and used machinery and the final washout of the trade-ins, it's necessary to use a sound basis in the valuation of the used equipment for inventory purposes. Guidebooks lay down an effective basis for a realistic valuation of used equipment. All trade-ins should be placed in inventory at the as-is value. Equipment not listed should be inventoried at 80% of a conservative resale price. Each time a new guide is issued, the dealer's used inventory should be reevaluated to the latest as-is figures. This also corrects the depreciated value of a trade-in that remained in stock too long. On the operating statement, we look for the margin, which is the difference between total sales and total cost of sales. There are margins for new and used equipment, parts and service. On this operating statement, the margin on new and used equipment is about 7% without volume discount, and it's about 11% with volume discount. Parts and service departments are 30% each. The final and most important item on the operating statement is the total sales and profits, all departments. After deducting all expenses, both actual and accrued, this dealer's total net profit after taxes is $4,722.19. This dealer has kept accurate financial records of every transaction. Now, he's ready to take the second step to increase his profit power. Use his financial records to determine what corrective action, if any, must be taken. An analysis of successful case dealers indicates the use of important checkpoints to safeguard capital, profit, and inventory. These checkpoints send out warning signals in troubled areas. It's up to you to watch for them, get the message, and take action. Now let's look at these checkpoints. First, capital checkpoint number 1. Rule of thumb is to have enough cash on hand and money in the bank for 1 month's operating expenses, plus cash for special payments such as income tax. To take guesswork out of your ability to handle current debts, put the capital checkpoint number 2 to work, which is the current ratio. To figure it, divide current assets by current liabilities. Current ratio should be 2 to 1. $2 of current assets to $1 of current liabilities. If the current ratio is less than 2 to 1, it means creditors have a bigger investment in your business than you do. If the current ratio is more than 2 to 1, assets are not working for you. Capital checkpoint number 3, the quick ratio checkpoint, measures quick debt-paying ability. Quick assets are cash, receivables, and securities. Quick ratio should be 0.6 to 1. Moving on from capital checkpoints to profit, you can keep your profit picture in sharp focus by keeping track of dollars earned on net worth. Do this by using the profit checkpoint, which is the return on net worth. Divide net profits by net worth to figure the ratio. All net profit ratios should be based upon profits after a fair salary for the dealer has been taken into consideration. Return on net worth should be at least 16%. Next, let's look at the inventory checkpoints. Inventory turnover in new machinery sales should be at least 2.5 times year-end inventory. Used equipment sales, 4 times year-end inventory. And repair parts sales, 2 times year-end inventory. These checkpoints that we have been discussing on capital, profit, and inventory give you a quick look at your financial picture. Now, to keep the business moving in the profit direction, set your course with these further checkpoints: receivables turnover, net working capital turnover, ownership equity, and turnover of total assets. Let's look at the first one. Receivables turnover. Divide total sales by receivables. Receivables turnover should be in proportion to total sales. If it is, operating money is working for you. If receivables turnover is low, it might be a warning signal to tighten up on collections. This is the time to take a close look at your aging analysis of receivables. Our next checkpoint is net working capital turnover. In order to obtain this ratio, we must first determine our net working capital, which is done by subtracting current liabilities from current assets. Now, we can figure the rate of turnover by dividing sales by net working capital. Turnover should be 4 or 5 times. If this ratio is too high, it could mean that the dealership is short of cash. This situation promotes borrowing, or the sale of equipment at a loss to meet payroll and other fixed obligations. On the other hand, when the ratio is too low, it indicates capital is not being used to best advantage. Capital should be put to use to increase sales. Another checkpoint is ownership equity. This puts the finger on just how much of the business you own. Figure the ratio by dividing net worth by total assets. Ratio should be 50%. The next checkpoint, turnover on total assets, indicates whether or not capital is adequate in relation to sales volume. This is determined by dividing sales by total assets. Now, you're sailing closer to your destination, and the next 4 checkpoints will chart your course towards return on your investment. These final checkpoints are return on assets, margins, expenses, and inventory to net working capital. Let's look at return on assets. This checkpoint is figured by dividing net profit by total assets. It should be from 7 to 11%. If it isn't, you're not making the profit you're entitled to. Use this checkpoint to set some goals. When it comes to checkpoints on margins, combined margins on new and used equipment, including volume discount, should be 15%. Parts margin, 30%. And service shop margin, 30%. The expense to sales ratio checks the heartbeat of business expenses. If expenses go over 14%, you're taking profit out of your pocket. Finally, let's look at inventory in relation to net working capital. This ratio is extremely high in the farm and construction equipment business. There are 2 reasons why. Inventories are heavy and represent a major portion of total current assets, and whole goods are heavily financed. A dealer who manages his business so that each phase of it equals or surpasses all of these checkpoints can expect to have a very profitable operation, provided he also maintains a satisfactory volume of sales. It's not impossible to meet these goals. It's being done every day by successful case dealers. The principal difference between dealers who are making a normal profit and those who are not is two words: business management. Let's re-examine this dealer's statement and use the checkpoints to determine what operation, if any, is below standard. First, let's put all the figures on one piece of paper. Now we have all the financial facts at our fingertips. What about this dealer's capital picture? He has $24,000 cash on hand. Rule of thumb is to have enough cash for 1 month's operating expenses plus any special payments. He's okay here. But, as it was pointed out earlier, money in the bank doesn't necessarily mean that all is well. What about his debt-paying ability? Let's check it out with his quick and current ratios. Quick ratio should be 0.6 to 1. This dealer has about a 0.25 to 1 quick ratio. Current ratio should be 2 to 1. This dealer has a current ratio of 1.2 to 1. These figures indicate that his current position is below par and that creditors could have a bigger bite of his assets than he does. Ownership equity verifies this. The dealer should own at least 50%, but he only owns about 25%. So chances are there's trouble ahead. Let's move on to the profit picture. Return on net worth is about 6.5%. This is too low. It should be at least 16%. Is this dealer making the kind of profit on his investment that he should be making? Obviously not. Let's go back to his financial statement and check his receivables turnover. It should be 12 to 15 times, but it's only 9 times. This indicates that he should tighten up on collections. His net working capital turnover is about 7 times. It should be 4 or 5 times. Since the figure is higher, it means that he's selling a high volume with a relatively small amount of working capital. He's relying heavily on his creditors' capital. Let's see how he stands on his inventory turnover. New machinery and parts turnover are in line, but his used equipment turnover is out of line. It should be 4 times year-end inventory. It's only 1.4. Here is a loud and clear warning signal. Margins on parts and service shop are right on the nose, 30% each. But his margin on new and used equipment is only about 7%. With volume discount, it's about 11%. This margin should be at least 15%. So, here's another warning signal. One more item. Expenses to sales. Expenses should not be more than 14% of sales. He's fine here. Expenses are only 9%. But it's become clear now what this dealer's problems are. He has a combined new and used equipment margin of 7% without volume discount and about 11% with volume discount. It should be at least 15%. And he's turning his used equipment inventory only 1.4 times instead of 4. This has reduced his sales margin. The profit that he made on new is tied up in used inventory. He must concentrate on his used equipment to transfer it to cash. If this isn't done, he could soon find himself sailing in some rough financial waters, even though he's making a profit. Instead of being able to settle his floor plan notes with proceeds from used equipment sales, he has had to use needed operating capital to settle the notes as they came due. Since he has limited capital, sooner or later some will become past due. Then he'll be forced to pay interest. At the end of the year, the past due is deducted from his volume, lowering the cash volume discount that he would receive. What should this dealer's first step be? He can begin by seeking counseling from his case representative. If he has kept accurate financial records and has used these records to determine corrective action, then he should be able to take the necessary steps without delay. What are some of the things he can do to convert that used inventory into cash? He can recondition and repaint those trade-ins to move them faster. It's been said that paint is worth $100 a gallon when properly applied to a used machine. He can also put some promotional ideas to work, perhaps double his salesman's commission on used equipment, do some special advertising, and maybe offer a 50-50 30-day warranty. The important thing is to be able to spot a weakness and do something about it. The successful dealer in any business can no longer depend entirely on shrewd business sense to achieve a profit goal. He has to know what's happening in every department: new equipment, used equipment, parts and service. Only when he knows can he take prompt corrective action if sales or profits fall below established objectives. The key to profit power is good business management. How do you get this kind of management? You can get in touch with your dealers' association for their recommendation. Tell them you wish to purchase a bookkeeping system. Tell them you want it set up and your bookkeeper or local accountant given instructions on how to maintain it. When your bookkeeper presents the monthly financial and operating statements, analyze them. Check your progress and results against the important checkpoints we've discussed. This will help you determine what phase of your business is below standard. Decide what you're going to do to correct it, then do it. It won't take you long to focus in on the hot spots. And if you move into action right away, you can put the fire out. To increase your profit power, you must have complete and accurate facts at your fingertips. And complete and accurate facts are available only if you have accurate records. With complete and accurate records, management becomes more manageable and decision-making more profitable. It's up to you. You have the profit power.